Well, y'all know that I'm a bull, but I love talking about the bear case because I want to see what evidence the bears have to actually be those dirty, lonely bears that they are. Just kidding, I still love you, no I don't. No, we could still have a beer. No, we can't, I just changed that. Although I might flip-flop. No, maybe I won't. Anyway, let's actually talk about this piece out from T.S. Lombard, which just came out on looking for the next weakness. You know, why is it that it seems the bears keep having to come out with new excuses for why the market's going lower than it did in October? It's almost like they're running out of reasons. But you know what? They're still bearish, and I'm still going to cover it because I want to see, am I missing something? Because I'll tell you, the day I see something that scares me, I'll have to weenie baby and sell everything. Just kidding. It usually takes me at least a few weeks before I flip-flop. But anyway, financial sector cracks spread to the economy. Tightening is likely to be stronger and more unpredictable. The risks we know are less worrying. Now, that's interesting because usually these folks are very bearish, right? And I actually wrote that little note over here. I'm like, that's odd. They're usually very bearish. Don't worry, they get bearish. So, first, regarding the banking risk, their chief economist at T.S. Lombard has a house view, which is that the main takeaway of the banking turmoil is that we're likely to see a credit crunch rather than more bank failures. And while there are other risks out there, the broad conclusion is that a credit crunch will feed through into the weaker real economic performance, which in turn could touch off further financial disturbances and thereby compound. The most likely candidates emanate from China and more broadly, commercial real estate. Okay, quick note on China because everybody keeps talking about how China is going to go back and boom. Yesterday, Bloomberg did this live a blog on the Chinese premier's piece. The Chinese premier was saying the world is at a crossroads. Now, what I thought was really interesting is throughout this piece, the premier talks about how China is booming. And like their recovery is so stable and so much better than the United States' recovery. Well, what do you have over here? I thought this was like the best line ever. Li used Hainan's allegedly resurgence in the tourism industry, as an example of China's rebounding economy. While I generally agree with Li, says the reporter, that things on the ground here in China are good, I can say, as someone who's been booking hotel rooms, there are a lot of vacant rooms. I read that and I'm like, of course. China is probably blowing smoke. They're probably doing a lot worse than they are actually letting on. They did the same thing with COVID. Why would they do anything different for the recovery? So of course the recovery is probably not as strong as this. This is why I have such problem trusting China. And don't get me wrong, I don't trust our government either, but I trust our government more than I trust China. And that's saying something. But anyway, going to this T.S. Lombard bear piece. So, China and commercial real estate, the potential targets for real pain. Okay, tightening is likely to be stronger and more unpredictable. Okay, so let's learn a little bit why. The hard landing risks have clearly risen. Why? The economy needed something to slow down growth and thus inflation. But the problem with tightening lending comes from a credit squeeze that is unpredictable. The FOMC, the Fed, is unsure how much tightening has occurred, and notable hawks like Neil Kashkari are getting understandably worried. The curve is strongly signaling a recession, and after the curve reinverts, we tend to signal a recession has begun. And markets, therefore, are remaining on edge. But what's most important? Well, what's most important, says T.S. Lombard, is this. Shaken confidence in the economy. Has this banking crisis now affected people's willingness to spend? Recessions can become self-fulfilling, they say. They say headlines of doom and gloom and recession and forecasts can negatively impact the investor, the consumer, and corporate behavior, feeding negatively into GDP. Though the bulls on the flip side argue that, well, maybe we're so prepared for a recession that a recession won't actually happen because we hit the brakes on our spending to allow us to spend less so we don't have as bubbly of a GDP, but we could actually spread out how long we could survive the fight against inflation. Think about that graphically for a moment because I think it's interesting to potentially consider. So the bears say, okay, if that's recession, so let's draw that straight. If that's recession right here, In other words, that's the zero line right here. That's recession. Well, the bulls make the argument that, hey, look, GDP is doing so well. Uh-oh, recession's coming. Hey, let's moderate our spend and basically have the economy do this sort of like U-shape, right? Well, the bears say, no, you're going to have a recession. People are blind to the recession until all of a sudden they're not, like a financial crisis. And then maybe you get something like that, right? And this is recessionary, whereas this is not. It's an idea. So anyway, as our chief economist argues, jobs and income expectations have never returned to pre-COVID levels, meaning the damage to spending will be larger. Now, I have a counter to that, but let me make their argument first. Okay, so here's another T.S. Lombard piece, which actually goes into the details they're talking about here. Basically, what they're saying is consumer confidence and consumer expectations of the economy have never actually gone back to the levels where they were. See, here's a sentiment chart, and they do have a very interesting chart here. They make the argument that when the Fed cuts rates, which is signified by this light blue line here, when the Fed cuts, you see sentiment plummet. Here's a cut, sentiment plummets. Here's a plummet in sentiment. Oh, look, cut in rates. Here's a cut in rates. Oh, look, plummet in sentiment. And look at this downtrend on sentiment on the right. Sentiment never recovered to 2022. Now, I have a couple counter arguments to this, but let me just first finish their argument. Their argument is because sentiment is lower today, in fact, right now we're sitting at like 2007 levels, basically this next recession is going to suck even worse because we're going into it with worse sentiment. Okay, well, now it's important to note the following. I think that's really important. And this is my counter, and then I'll keep going with their bear piece, okay? So my counter is the following. It's two-folded, okay? So number one counter and then number two counter, okay? I'll put my little reminder right there. So number one counter I wrote, not necessarily. If the Fed is cutting rates because inflation is conquered, expectations, in my opinion, could ironically rise. The reason for that, and I give an analogy, it's like being on a ship. If you're on a ship that crashes into an iceberg, you might be like, oh my God, we're cutting rates because we just hit an iceberg. Oh crap, we might die. But if you were on a ship for a year, and at the beginning of the cruise, they're like, hey, by the way, we're fighting icebergs and really high inflation. And then all of a sudden you see land and you're like, oh, the inflation's going away. The signal is, oh, it's clearing up. The signal is actually positive. In my opinion, your expectations actually go up, not down. Because in my opinion, in this rate cutting cycle, when the rate cuts happen, you're sending the signal that inflation is conquered. I don't believe the Fed will cut rates until inflation is conquered. They will shove our faces into the mud of a recession before they cut rates and inflation is still high. They will not let inflation unanchor. They will keep rates high until inflation is gone. That's why, in my opinion, when the Fed starts cutting here, it's a signal. It's a bat signal going, inflation's over, yay. That would be great. Very good. It's like seeing land and you have scurvy. You have scurvy and you're like, I need an orange. It's a good thing. It should increase your optimism, not decrease your optimism. The second thing that is a counter to this bear piece is they argue that, hey, but sentiment hasn't risen. Who cares if sentiment hasn't risen? You know what's risen? Cash. The amount of money people have, folks. The amount of money people got in their pockets, in their bank accounts. They got more money than they did in 2019. People have more money today than they had. Oh, look at this. There's literally a story on this right now. Rate hikes until inflation is killed, then return to normal. Let's listen to this guy for a sec.
No more runs on banks. Powell let it take the interest rates to wherever he has to take them to kill inflation. And then we can get back to normal.
Yeah. Dude, I swear, that guy was probably listening to my stream and then he's like, let me call into CNBC really quick and basically just say what Kevin was just saying. This is fantastic. I mean, obviously everybody subscribes to the Meet Kevin report. Yeah, that's a perfect opportunity to remind you to get life insurance in as little as 5 minutes, link down below. To make sure you check out the courses on building your wealth, link down below. Learn more about my ETF by going over to meetkevin.com and my courses, my live streams, my real estate startup, all that good stuff. Anyway, where were we before I went down this conceited rabbit hole that everybody obviously listens to Meet Kevin, hashtag don't sue me, bro. Let's go back to being humble. Where is that? Oh, I can't find it. Okay, so, okay. So T.S. Lombard makes the argument that the coming recession is going to hit with overall sentiment and job and income expectations below COVID levels, pre-COVID levels. People did not buy into the post-COVID rebound, meaning other than backing and filling to a return to whatever. In other words, when the recession hits, the damage to spending may be a lot more than most of us expect and turn the recession into a deeper one than anticipated. There is still a strong contingent believing no recession at all, but there were a lot of very smart people in 2008 and in the spring of 2008 who were arguing no recession was underway. That is true. There were a lot of people in like 2005, 6, and 7 that are like, oh, real estate's just gonna level out. It's not gonna crash. Don't worry. Oops. So I don't know. I mean, I have my bets placed. But anyway, so they talk about being short and underweight real estate. Mr. Schiller actually came out with a piece yesterday. He was shilling on basically how he thinks real estate's going to be in a much better position to buy in 6 months. And I'm like, wow, even a Yale economist, Mr. Robert Schiller, the founder of the Case-Shiller Index, watches the Meet Kevin report. Because obviously, if house hacks buying in Q3, Q4, we got to reiterate that. Now, it's true. He actually said that yesterday. It's really interesting. I don't actually think these people watch the Meet Kevin report. Maybe they should. But yeah, I think that's very interesting. So, okay, so the bear piece is clearly established here that these expectations could potentially lead to a worse recession. It's an argument. Personally, I kind of think the bears are like grasping at straws at this point. You know what to me signaled that the Bears had kind of lost the plot? It was when Morgan Stanley and Mike Wilson, oh, I have it right here, had this piece. This, to me, is when I thought the Bears lost the plot. You ready for this? The perfect analogy for where equity investors find themselves today, and quite frankly, where they've been many times over the past decade, more specifically either by choice or out of necessity, as stock investors follow prices to dizzying heights once again, is liquidity, just like bottled oxygen, that allows them to climb into a region where they know they shouldn't go and cannot live very long. They climb into the pursuit of the ultimate topping out of greed, assuming they will be able to descend without catastrophic consequences, but oxygen eventually runs out for those who ignore the risk. Because after all, there is a peak 3,000 feet above what is known as the start of the death zone at Mount Everest. And basically, stock investors are being morons who are going into thin air, expecting not to survive. Yeah, good one, Morgan Stanley from February 19th. Can somebody please send Mike Wilson an email and tell him to watch the Meet Kevin report and stop being such a bear? I would love to talk to Mike Wilson about PP together. Pricing power. But anyway. I hope I didn't just get the guy in trouble. I actually like his perspectives. I think he has, we cover him very regularly on here. He gets a lot of coverage, and I like understanding and viewing his bear point. I actually do agree that the S&P 500 is probably going to go down substantially, but that's why I'm ignoring the staples within it. But then again, Morgan Stanley's Mike Wilson's going into the staples, like Walmart. I mean, yesterday we were tearing apart Walmart and Colgate, Palmolive. Come on, Mike. Mike, we need to have a beer and we need to talk about this. And I haven't had alcohol for like 12 days, so that's saying something. I mean, I'm basically sober. With that said, it's important to remind you to check out the programs on Building Your Wealth link down below. Make sure you get your life insurance in as little as 5 minutes by going to medkevin.com/life. Not only go to medkevin.com/life to sign up in as little as 5 minutes. I went through the prompts yesterday. It is literally as little as 5 minutes. I personally use that life insurance policy. It's great. But also check out the courses on Building Your Wealth link down below for our private course member live stream, the next of which starts soon. Love to see you there. You get my buy-sell alerts as well, specifically where we sell puts and